Let's talk about your money. It's taxed when you earn it, it's taxed when you spend it, it's taxed when you invest it, and it's even taxed when you die. Every day, Uncle Sam dreams up new ways to take a cut of your earnings. So if you're concerned about the taxes that you have to pay, keep watching as we tell you some of the best tax dodging hacks that no one uses, but they should. Everyone thinks that tax hacks and loopholes are only for the rich and powerful. That couldn't be further from the truth. The fact is that knowledge is power. Tax laws can be used by anyone, but you have to know what they are and when to use them. Let's dive in. The first tax hack is that long-term capital gains can be taxed at zero. That's right, tax-free. So Matt, what does it require for a capital gain to be tax-free?
Yeah, great question. So you'll want to just pay careful attention to your marginal tax bracket. The numbers aren't exact, but basically if you're in the 12% bracket, then you'll pay 0% on your long-term capital gains. And this is huge, but you need to hold those funds for a year and a day or any security that you're investing in. And so that day is very important. It's a terrible thing to run into at the end of the year if you didn't sell it over a year and a day, and now you're running into short-term capital gains.
Right, so pay attention to your holding period and pay attention to what tax bracket you're in, but there is a chance that you could be selling gains tax-free, which is a great way to unwind concentrated positions or low basis stock and pay nothing in taxes.
Right, so maybe you had a good run on your individual securities. Now it's a great time to sell out of those, pay 0% long-term capital gains, and then go into a diversified portfolio.
Right. Number two is a charitable remainder trust. So how does that work, Matt?
Yeah, so a charitable remainder trust is an irrevocable trust, meaning that once you put these dollars into the trust, you can't reverse it. So work with your tax advisor and your financial planner to see how this can work for you. But listen to this, it's an awesome hack because you get a tax deduction up front. And then based on the number of dollars you put into this, you actually get an income stream for a number of years, up to 20 years. And then whatever's left in this gets left to charity. So you're creating an income stream for yourself while you're living. You got that tax deduction up front, and then you're able to leave something to a charitable organization.
And anybody can do this?
Anyone can do this.
What's number three?
So number three, believe this one or not, a T-CRUT.
A T what?
A T-CRUT. So this is the same concept as the charitable remainder trust. And you've probably heard us talk about not necessarily wanting to put a trust as your beneficiary on your IRAs, but you may want to consider this because you can put the T-CRUT as beneficiary on your IRA. Instead of the new rule right now with IRAs, inherited IRAs, you have 10 years to fully deplete that account. If you put the T-CRUT as the beneficiary, it gives you that 20 years to spread out that income. So this can reduce those required distributions over the years, putting more dollars in your loved ones' pockets and also leaving dollars behind to charity.
It's kind of like bring back the old stretch IRA days.
That's right, yeah. So keep in mind the T-CRUT is irrevocable, so you can't change this once it's set up. So what are some other ways that you can give to charity?
Donation of low cost basis stock to charity is a great way to do well by doing good. So if you don't want to do an irrevocable trust, but you still want to give to charity, consider donating your low basis stock. This is the stock that will have the largest taxable gains in it. Not only did you get a tax deduction for making this donation, but it's also a great way to diversify your portfolio and reduce some of the concentration risk.
And then you could also give to your family members or friends the low basis stock. They may be in a lower tax bracket at that point, so gifting it to them, it's not necessarily giving you a tax deduction, it's saving you on not having to pay the taxes by selling the stock. But the kids, maybe they're in the 12% marginal tax bracket, and now they're getting 0% long-term capital gains.
So tax hack number 4 is using a health savings account, or an HSA. This is the best investment vehicle on the planet. It's triple tax advantage. You get a tax deduction when you make contributions, like a 401k, and when you take money out to use for qualified medical expenses, it's tax-free.
And one of the cool things about this, with this account, you do not have to reimburse yourself back in the year that you use the qualified medical expense. And so why would you do that? Well, let's say that you have a qualified medical expense, but you can pay for it out of pocket. Now that allows you to invest those dollars within your HSA and grow them over time to have more tax-free dollars in the future.
Right, and one strategy we love is make your contributions to the HSA, invest the money, grow it over the decades, and then use the future pot of money that's going to be much larger because of compound interest, use that to cover your long-term care expenses. That's what we see smart people doing. Tax hack number 5 is being smart with your strategy on RSUs, or restricted stock units.
Yeah, so believe it or not, the RSUs are actually taxable on your W-2 as soon as they vest. So even if you didn't want them and they vested on there, you're going to be paying taxes here. And that's your ordinary income tax rates. So here's the tax hack is, if you get them, you're already paying that ordinary income tax. You could sell those there right away and then go diversify in a portfolio. So what does that allow you to do? It allows you to avoid the capital gains tax in the future on those. So now you can take advantage of tax loss harvesting with multiple exchange traded funds in your portfolio.
Tax hack number 6 is use donor advised funds. You know you're charitably inclined, but you want to see that money grow so you can make a bigger impact in the future. If that's the case, contribute to a donor advised fund and enjoy a nice tax deduction this year. Then invest and grow your money and give it away to the charity of your choice in the future. This is a great way to involve your kids or grandkids and get them charitably inclined as well, while also learning about investing and the markets. And tax hack number 7 is use qualified dividends.
Yeah, believe it or not, dividends are taxed different depending on what kind you have. There are qualified dividends and there are ordinary dividends. So qualified dividends are taxed at your long-term capital gains rates, which can be 0, 15, or 20%, as opposed to the ordinary dividends that are taxed at your ordinary income rates. And so in order for them to be qualified dividends, you have to hold the holding for 61 days, and it typically needs to be a U.S. holding. So just be careful which of these dividends you're using, because one could be taxing you more than the other.
Right. And tax hack number 8 is for you business owners, put those kids on payroll.
And Brad, you've got a number of kids, right? They're old enough for payroll. How do we do this?
I do have a few kids. So what you do is, if your kids are old enough, it's got to be legit. You got to create a job description, but you put the kids on payroll. And what that does for you is you can pay them up to the standard deduction, which this year is $12,000. So you pay them up to 12, and the kids don't have to pay any federal taxes on that. And depending on what state you're in, they may or may not pay state taxes either. And then the kids can make contributions to their 529 plans, or they can make contributions to Roth IRAs. So the 529 plans will help them save for college. So essentially, it's a tax-free way for you to get money into the 529 plan to pay for an expense that you're going to have down the line anyways. You're able to do it in a tax-free way that no one else can do by putting those kids on payroll. Tax dodge number 9 is a strategy known as bunching and clumping. Matt, how does that work?
Yeah, we know that you're most likely giving to your 501c3 because you want to give and give back to your community, but why not save some taxes along the way, right? And so this strategy is because the standard deduction is so high, it's getting harder and harder to get over that. And you either take the standard deduction each year or the itemized deduction. So the strategy is, what you do is, instead of giving to charity every year, maybe you give every other year or every few years. And then so maybe that one year you're taking the standard deduction, that second or third year you're getting above the standard deduction, so getting a higher tax break, and then keep repeating it, rinse and repeating that one. And tax hack number 10, it's new for 2025.
This is known as the Super Saver Catch-Up Contribution. For those of you between age 60 and 63, you can contribute an extra $11,250 to your 401k, which is a great way to get a larger tax deduction. So definitely take advantage of it this year. While there's many, many more tax hacks to speak of, these are our top 10 for a reason. It's because we utilize many of them for our clients to help them in their goals of building wealth for themselves and for future generations.
And if you would like to see where you can save money on your taxes, use the link below and we'll give you a free tax analysis report.
Make sure to like the video and subscribe, share with anyone who you think can benefit, and we'll see you on the next one.